Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We're counting down to the next VRIC, January 21st and 22nd at the Vancouver Convention Center. But of course, in the meantime, we're bringing you great guests each and every week. And today's guest is the managing director of the CPM Group, one of the world's premier precious metals and commodities research and consulting companies. It's Mr. Jeffrey Christian. Great to have you on the show.
Thank you, Jesse. Yeah.
So I want to get started with your current assessment of the precious metals market, starting with gold. We've seen gold come very close to previous all-time highs. A lot of people are saying that once it cracks that level, it will probably happen in 2023. I've heard several people say. So I really would like to get your perspective on gold from both a fundamental and technical point of view. How do you think gold is going to perform for the rest of this year?
Well, our expectation is that you might see the gold price cool off. Excuse me a little bit. You might see the gold price cool off a little bit now. We're recording this May 1st through September or so. There's some seasonal weakness that tends to show up in fabrication demand, also investors. We look at the macroeconomic environment and the political environment a lot. And while there are a lot of problems out there, they're not as bad as maybe they seemed 2-3 months ago, February, March. And we wouldn't be surprised to see the price of gold cool off over the next several months and sort of stabilize. We don't see it going back to 1680 or 1624 the way it did last year, but we wouldn't be surprised to see it, come down relatively dramatically. It's around 2006 this morning. It could come off quite sharply over the next several months. But there are any number of economic and financial market and political events that we think will actually get worse. Maybe not in 2023, maybe in the fourth quarter of 2023, but perhaps more likely in 2024. That's what we've been saying for several years. Other people who have been saying 2024 are now shifting into the fourth quarter or the second half of 2023. It's very difficult to project the arrival of recessions and financial crises. You can see them on the horizon. You can expect them. But when and how they'll break is hard to project. So our expectation is the price of gold kind of cools off a little bit for 5 months or so, and then starts picking up in the fourth quarter of this year and rising. Now, within that context, because an investor, unless you're one of these guys who's sitting in front of the screen buying and selling on an intraday basis, an investor should think in terms of quarterly and annual average prices. The annual average price last year was $1,804. That was a record annual average price, up from about $1,799 the year before. There are any of those other people who say, well, no, yeah, but the price went from $2,060 to $1,620 on an intraday basis over the course of 2022. But that's not what matters to a long-term investor. And I think like a long-term investor. So we had 1804 last year as an average. We're looking for something north of 1900 as the average price for 2023. That's up almost 10%. And then we're looking for another 10% in the annual average price next year, 2024, because we do think that the economic and political environment will be worse in 2024 than it is going to be for the rest of 2023. So we're, well, I'm saying, well, yeah, we think the gold price is going to cool off. We're looking for sharply higher record annual average prices this year.
Very concise breakdown. I like that. And the timing, yes, very hard to obviously forecast. I'd like to move into silver now and get your thoughts on where silver is positioned as we sit here today. A lot of the time in precious metals bull markets, silver can tend to outperform gold, at least for a time. So where do you see silver headed, and how much do you factor in its industrial use? Particularly, a lot of people are pointing to its increased use in solar panels. Do you see that being a factor as well, pushing the silver price higher moving forward?
Well, I think there's a tremendous amount of misinformation and misunderstanding about silver and gold. I mean, and everything else in the world, it seems. The increase in solar panels use of silver is going to be very supportive of silver prices. It already has been over the last 2 decades, and it will continue to be over the next decades to come. It won't be as dramatic as some of the promoters and other people say. They grossly overestimate the amount of silver that's going to be used in solar panels, and they completely ignore the fact that you will have solar panels at the end of their useful lives being recycled, which will generate silver to be used, which will reduce the net demand for silver use in solar panels going forward. Our view about silver on a shorter term basis, more parallel to what we were just talking about with gold, is that I think that silver in some ways may overperform gold and in some ways may underperform gold. Gold and silver are financial assets as well as commodities. They trade like financial assets. If you look at the trading patterns in gold and silver and you say, where do I see this? You don't see it in corn or aluminum. You see it in US dollars, euros, and US treasuries. Gold and silver trade like financial assets and they move like financial assets. Gold is seen more universally than silver as a financial asset. Silver is seen as a financial asset, but in an environment like the one we're in now and like the one that we see ourselves going into economically and politically, I think more people are more interested in gold. And we've seen that in gold over the last few years, and I think you'll continue to see it in silver over the next few years as well. Silver will do well. As with gold, we wouldn't be surprised to see the price cool off for the next few months in the remaining, second portion of the second quarter and the third quarter of this year. But we do think it will pick up, and we do think that it will go to record annual average price, slightly higher than the record annual average price that we saw in 2011, 2012. And probably not quite as dramatic as gold.
So I wanted to get to the hype that exists in the silver and gold sector, as you alluded to, and you take a very measured approach, as we can see from those answers you just gave to the outlook for gold and silver. And I personally really appreciate that because there is a lot of promotion in the space. So I'm wondering, what are the main data points that you generally look at when you do make forecasts in the gold and silver space? And how should investors approach the sector without getting caught up in the hype?
Well, investors should stop listening to people who have a history of being wrong. As you said when you reached out to me, there are these guys, and you've interviewed a lot of them. There are these guys who have been talking about, $100 silver or $10,000 gold for 1 year, 2 years, 10 years, 40 years. There's one guy I know who has been talking about the collapse of the Western economy since the late 1960s. And people listen to him. You've got to stop listening to these people. That's the first thing. The second thing is, you have to stop and you have to study. I mean, I participated in a full day boot camp on energy and battery metals on Saturday. And you had investors actually paying people to listen in all day Saturday to a number of people who actually knew what they were talking about lithium and manganese and cobalt and electric vehicles and energy transformation and the energy transition. You got to do your homework. Now, I've seen people, I knew the Hunts back in the late 1970s. Nelson Bunker Hunt once joked that I was the last guy in Manhattan he was willing to talk to, that he would trust talking to. I have seen multimillionaires, centimillionaires, billionaires, people who have made enormous fortunes in their particular industry or industries. And then they decide to invest in gold and silver, and they take everything they know about rationally studying a financial opportunity, and they flush it down the toilet, And they say, oh, some guy who's been wrong for 30 years tells me that gold's going to $10,000. I'm scared. I'm getting old. I'm very wealthy. I'm worried about losing my money. I think Hillary Clinton's going to make us all use the same bathrooms, so I'm going to buy gold. And you got to get away from that mindset. We're rationalists. There are people who will say that we're bearish on gold because we only think it's going to $2,400 or so. But we studied the markets. We understand the cost of production and the potential production from mine production, secondary recovery, fabrication demand, central bank activity, and investment demand. There's a lot of garbage information that's out there. You'll hear that silver's in deficit. Anybody who tells you that silver's in deficit doesn't know what they're talking about, or they're purposefully misrepresenting the silver market by throwing investment demand in with fabrication demand so that they can say, oh my God, the silver market's in a deficit, the price has got to skyrocket. The silver market's in a surplus. Fabrication demand is less than total newly refined silver. And that surplus has to be absorbed by investors. If investors want more silver than that surplus, they'll bid the price up. If they want less than that surplus, the price will fall. It's that simple of a mechanics, but you've got to get all of the components, mine production, secondary recovery, fabrication demand by sector. You hear a lot of people talk about the tremendous amount of silver that left London and went to India last year. But they never mentioned that 30% of that silver was re-exported from India to other plations. The Indians were making a transaction. They were saying that I can buy in London and I can sell in Hong Kong and I can make, 50 cents an ounce, whatever it was. So I'm going to do that transaction. And so you hear all these people hyping the silver market, talking about this tremendous amount of silver that went into India. Yes, a tremendous amount of silver went into India, and 70% of it was used, and 30% of it was re-exported. So you've got to do the homework. You've got to study stuff, and you've got to say to yourself, does this person have a track record calling the market accurately? And there's a lot more there too. But, we always say, the four sins of the intellect: stupidity. You just don't know what you think you know. A lack of intelligence. You can't think critically. Being deluded, letting the snake oil salesman convince you that the world's going to hell in a handbasket, and self-delusion. I know more than everybody else. And you hear these guys who say, okay, I didn't even graduate from college, but I'm on the internet and I'm telling you that the Fed can't succeed. And I know there are 350 economists that do the consumer price index at the Bureau of Labor Statistics. And I can tell you that they lie about the consumer price index. It's like, I've never studied economics, but I'm smarter than tens of thousands of economists who have no rational reason to lie or misrepresent reality. They're paid to get the data right. But I can tell you from my position of ignorance that consumer prices are higher than the consumer price index. And you've got to get away from the nonsense. Unfortunately for my job, one of the worst things about my job, I have to pay attention to the nonsense. Because while I try to spend most of my time looking at the real markets, I keep getting calls from people say, well, so-and-so just said that, gold's going to $10,000 because the Fed doesn't know what it's doing. So I have to listen to that stuff, and it's an occupational hazard for me.
Right. Yeah, that makes a lot of sense. I want to switch to a presentation that you gave recently on the CPM Group channel, where you talked about the investment demand of gold and silver jewelry, which I found interesting because it's not something that's often discussed. So could you break down the main points of that presentation for us and fill us in on how much jewelry plays into the demand for gold and silver?
That was a really cute presentation because I brought some show and tell. I brought a statue of Ganesha that was given to me in Mumbai. It wasn't for payment for giving a speech, but as an honor. honor for giving a speech in Mumbai. And it was exactly 10 ounces of sterling silver. So it was a statue of Ganesha. It was a beautiful adornment. It's in my dining room on the sideboard. But I know it's exactly 10 ounces of silver. So I know what it's worth, you know. And I also brought along a necklace I had bought for my wife decades ago in Dubai in the souks, which was exactly 1 ounce of gold. So, you know, you do it. But, you know, there are several things. One is that jewelry and silverware and decorative objects have always been a form of savings. It's adornment and it's a fashion statement, but there's also a form of savings there too, right? And then you have other places like depending on what sect of the Islamic world you live in, women cannot own anything but what they wear. And if their husbands die or divorce them, his wealth goes to his family, not to her, the wife, or the wife's children. So in some Muslim sects, you will find a tremendous amount of investment in gold jewelry and silver jewelry, because that's the way a woman can legally in that religion or that portion of Islam own something. You know, so you see that, but then you see cultural things too. So in India, where it's mostly, you know, it's 90% Hindu, but you do have a very active investing Muslim population. But, you know, in India and in Southeast Asia, you have a lot of jewelry that is purchased as a form of investment and as a form of savings. And if you go to the souk in the Middle East, or if you go to what they call pawn shops in Malaysia, or you go to the bazaar in India, you'll find housewives, you know, selling jewelry because they're on their way to buy groceries, or buying jewelry because they've got excess cash, and rather than save it in rupees or ringgits or dirham, they will save it in gold and silver.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
And how much does the actual gold and silver jewelry market actually play into the demand for the metals? Is that something that you even consider or factor in? Is it more of an aside, or is it something that actually drives the market?
It's something that actually drives the market. You know, if you do the econometric research, what you see is that investment demand drives the price, and the price drives mine production, secondary recovery, and fabrication demand to some extent. Now, there's a do loop back. So fabrication demand affects the price, but the price affects fabrication demand, jewelry demand more, you know. And then you have to say, okay, some of that jewelry demand is actually investment demand. In our data, we have investment demand, which is refined bullion and bullion coins. And then we have jewelry demand, which is part of the fabrication demand because it does have a fabrication cost applied to it. It's not necessary, you know, in some places it is tangible and fun and readily fungible for money. But in other places, for example, North America and Europe and Japan, you pay a large discount for selling it. But, you know, so we define investment demand in our data as refined bullion and bullion coins that you're going to be able to sell at something close to the bullion price. But the jewelry demand has to be there. And we did see this in, I guess, the 1990s. We started in India working with Indian bullion dealers to actually segregate the investment market, the jewelry market, because the jewelry market and the silverware market is several markets all lumped together statistically. You know, so you have jewelry for adornment, you have, you know, jewelry as a consumer discretionary purchase, but then you also have jewelry as an investment demand, and you have silverware for gift giving, but then you also have silverware and statuary for quasi investment purposes. And you really have to pay attention to that because it is a major thing. Now, one of the things that we've seen throughout Asia over the last 10 or 20 years is that investors are starting to segregate in their minds bullion from jewelry. So you've seen a decline in jewelry in some of these markets, in jewelry demand in some of these markets. And what it is an offset of the increase in demand for bullion or bullion coins or medallions. So there has been some shift throughout Asia as they develop economically, they develop a financial markets, they develop banking systems. There has been some segregation and saying, okay, if I want to buy bullion, I'm going to buy bullion. If I want to buy jewelry, I'm going to buy jewelry.
I wanted to put the recession question to you because what we're hearing a lot from people is that this is the most anticipated recession in history. It's baked in. There's no way to avoid it. It's ultimately going to be a deep, long-lasting recession. It's just a matter of time. Some are saying it's going to be more centered on the US. Others are saying it's global. What do you think of all this? Are these fears of recession overblown, or is this a surefire thing?
Well, I think some of the people that you're talking about probably wave their arms hysterically when they're talking. First off, it's not the most anticipated recession in history. Anybody who doesn't anticipate a future recession doesn't know statistics because there's 100% probability of future recessions. The question is when, how big, and how long? How deep will the recession be and how long will it be? And you can't econometrically project those things. I mean, in 1978, I thought there'd be a recession in 79. I was wrong. It was 1980. In 2007, I thought there'd be a recession in 2009. I was wrong. It started in 2007. So it's hard to call it. Our expectation is that we're in the late stages of an economic expansion. If you take out that 2020 recession, because that was manufactured by governments through the lockdown. It was a unique recession. We really haven't seen a recession now since 2007, 2009. So we're way overdue for a recession in terms of things. But that reflects the fact that from 2009 through 2015, you had very low economic growth because of the tail of the Great Recession and the tail of the global financial crisis. And we really started coming out of that around 2015, 16, 17. But we're due for a recession. We are starting to see capacity constraints, not supply chain problems, but actual supply problems. And those problems will probably continue because we've had a long period of growth. And because we have things like, for example, vegetable prices and vegetable supplies are going to be severely constrained in North America because of all of the flooding that you're going to have in California, in the vegetable patch in California. So you're seeing supply constraints pop up here and there in the economy. They'll get worse. You're seeing a cooling of consumer demand. You're seeing a cooling of business investment and expenditures by corporations. You've had a big decline in the fiscal stimuli. It's still enormous. It's well over $1 trillion, deficit by the federal government. But you have seen it go from 3 trillion or 3.7 trillion to 1.7 trillion. So you've seen a steep reduction in the fiscal stimuli coming in. And you're seeing monetary policy tighten some. So you put all four of those factors together and you can say, yeah, we're headed toward a recession. How big it will be is anybody's guess. Our view is it's probably going to be much bigger than the recessions that we saw in 1991 and 2001. Probably not as big as the recession that we saw in 2007 through 2009, but pretty big and pretty large. It probably will, center on the U.S. because the U.S. is still, a quarter of the world's economy. But Japan and the U.K. and continental Europe probably will participate. That will drag down growth in the developing countries, but probably not throw them into recessions. So you'll see significant reductions in the growth rates in developing countries, most developing countries. You have the Ukraine war, and the Russian invasion of Ukraine. That's going to continue to be a problem and an issue. There are any number of clouds on the horizon that probably are going to come together and create a pretty significant recession. One of the things that we always tell people is you have to understand recessions come and recessions end. It's not the end of the world. The dollar's not going to collapse. The treasury market's not going to collapse. The Western financial system that's basically been in place since the 15th century is not going to collapse. We will go through a recession and then we'll come out of it.
So I'd like to put the question of the US government debt to you and how you think the US will tackle its enormous and ever-growing debt obligations, if it indeed ever will. Will they need to return to QE at some point to not default on the debt? Is there any other way you can see of them solving it? Will they turn to endless QE, kind of Japanify the economy? How do you see that whole situation coming to an end, or will it even come to an end in our lifetimes?
QE is relatively meaningless to the debt. I mean, people focus on monetary policy for some crazy, unsupportable, intellectually unsupportable reason. It's really fiscal policy that you have to pay attention to. Now, if you look at U.S. debt, government debt, as a percentage of GDP, it was higher in 1947 than it is now. And the fix, I mean, we had William McChesney Martin running the Fed throughout the 50s and 60s, probably the best central banker in the world. But the fix came on the fiscal side. 90% marginal tax, right? You had the political will of politicians in the United States to say, we have 120% of our GDP in federal debt. We have to pay it down, right? And that means higher taxes and less spending. And people don't realize how shabby the White House got under Eisenhower. And when JFK took over, Jacqueline Kennedy actually raised private money to renovate the White House because it had gotten to be sort of like a London hotel. It was really run down. The government was relatively parsimonious in its spending, and it kept marginal tax rates high, 91% under Truman and under Eisenhower. Kennedy lowered it to 61%, and it stayed at 61% until Reagan came in and said, well, my buds, they want lower taxes. And that's when when Reagan took over, we had less than $1 trillion of debt. Think about that, less than $1 trillion of debt. And then Reagan and Bush the first and Clinton and Bush the second and Obama and Trump, they all added to it. Right? And there's a very famous quote from Nixon saying, I am a Keynesian, which was really abusive of Keynes's ghost, because what he meant was, I can do deficit spending. Keynes said, if you get into a recession, the government should spend more than it's earning, run a deficit to get us out of the recession. Nixon came along and said, screw the recession bit. I can just run deficits. I can just print money. And that's really when it started. So by the time Carter left the office, you had $58 billion annual deficit and $1 trillion of debt. And then Reagan said, well, we're going to slash taxes to like 34% initially, and we're going to double defense spending, and we're going to do this, that, and the other thing. And you went from $58 billion deficit to a $350 billion deficit. And we've been there ever. The solution to the current debt situation is in the fiscal policy. You need the political willpower on the part of politicians to say, we have to raise taxes. You have to have the political willpower of the voters to vote those people in. You've had since 1964, Ronald Reagan gave a great speech in 1964. He said, the Social Security system is going to be bust in a couple years. Yeah, that was 1964. That was 59 years ago. And his solution, and the solution of the Republican Party ever since, was we need to allow Social Security Fund to invest in the stock market and not just treasuries. That wouldn't solve the Social Security issue. What it would do is, you see, if I'm a bank or a brokerage house and I'm buying treasuries or I'm selling treasuries to the Social Security thing, I don't earn a commission. But if I'm selling stocks, I earn a commission. It was all just a big giveaway to the stockbrokers, right? And they have persisted with that. You have to get away from that mentality. And the political will, both on the part of politicians and on voters, just doesn't exist. If you can get that willpower back, then you can fix the deficit in the long run. That's a very pessimistic way of looking at the world because, Americans just don't seem to have the capacity to say, let's do that.
So, keeping in mind everything we've discussed so far, this current economic environment, which seems uncertain in many ways, what are the main assets that you think can first best preserve wealth? And are there any asset classes, maybe commodities outside of gold and silver, that might present an opportunity to actually be offensive in this current environment?
Yeah. The best protection of your wealth is a diversified portfolio and diversified wealth. Gold and silver have an integral part to play in that, but they are preservers of wealth and sometimes capital appreciators, right? Adam Smith in The Wealth of Nations, 1776, said, wealth is not defined by the amount of gold or silver or currencies you have in your safe. It's defined by the amount of money you have invested in productive assets because that will generate more wealth. Because gold and silver, despite what the bugs think, the reality is that gold and silver's purchasing power has depreciated in line with the currencies. A currency, gold and silver, have all depreciated in purchasing power over time. If you look at, gold denominated in 2021 dollar terms, in 1800, it would have been like $5,500. The purchasing power of gold is 60% off from where it was 200 some odd years ago. There's no golden content. That's a myth, right? You need that kind of asset in your portfolio. But what you really need, and what Adam Smith said and what Warren Buffett has said, which has also been misunderstood, is the best thing is to invest in gold mining companies and silver mining companies that are going to produce more gold and more silver. And that's really very good. You want the physical metal. It's an insurance policy. It's a capital preservation tool. It's a portfolio diversifier. It's a hedge against currency market depreciation. It's a hedge against inflation. It has a lot, gold and silver have a lot of value for investors, physical gold and silver. No cryptos. Physical gold and silver. But you also want to invest in a wide range of productive assets. Gold and silver mining companies are some of them. Then you have to look at the economy and you have to say, where are we and where are we going? I have to make an educated decision as to where I'm going to go. Do I want to, 20 years ago, a jaundiced investor making the right decision would have invested in big pharma making opioids because he could see that America was destroying itself with the opioid addiction, and the government was providing incentives for the opioid manufacturers to do this. You don't necessarily want to do that. You have to be very careful because there's the things that you think you should invest in, green energy technologies. And then there are the things that you think you shouldn't invest in ethically, but they're where the money's going to be made. So gambling, because you look at America today, it's opioids, it's drugs, it's medication, and it's gambling. It's non-productive assets. The average American family watches like 20 hours of television a week, and it's all shows. The average South Korean family watches like 2 hours of television, and they spend most of their time studying things and learning things and making sure that their kids are doing better so that they'll do better than they did. And the United States has a problem in, it's not just a lack of political will, it's a lack of a lot of willpower across different things. Get out and go walk, play soccer instead of playing video games, walk instead of watching TV. But you have to sort of say to yourself, which industries make sense? And, one of the things that we've seen in the financial markets, which is both good and bad, is the rise of indexed investing. And it's bad because it takes money away from the capital formation that companies need, because institutional investors invest in the indices instead of the companies. But it's good because the indexed investments, generally speaking, outperform the rifle shots. Oh, I'm going to pick this company. You can say, I'm interested in oil and gas because, as the International Energy Agency says, in 2050, petroleum is still going to be our major source of energy. Natural gas will be our second largest. Coal will be our fourth, having been displaced by all renewables combined after 2040. So we're still going to be using oil and gas and coal. And we need to invest in those industries. And we also need to invest in those industries that provide scrubbers to the power plants that burn natural gas and coal. You can clean that up. So there's a lot of interesting investments, but you've got to do your homework and pick the ones that you think will be the winners.
Well, thank you so much for joining us today, Jeffrey. Really appreciate your rational, level-headed approach to things. I think people are going to get a lot out of this conversation. For those who want to learn more, could you tell us about CPM Group and anywhere you'd like to direct people online?
We're a commodities research consulting company. We don't market precious metals. We have companies that do sell precious metals on both a wholesale and a retail level as clients. But what we do is our clients pay us to get the markets right, not just precious metals, but also specialty metals. Like we do a lot of work on high purity manganese, which is being used in lithium ion batteries, and molybdenum, which is used in high strength steel. Very interesting metal because the high strength moly based steels are used in pipeline. They're used in drill pipes for oil and gas and mining tests. They're also used for transmission pipes. And they're also used in the towers for windmills. So they have both the green energy and the traditional energy demand for that molybdenum. We do basic research across commodities, and then we advise clients on how to either take advantage of where we think the prices are going or protect their companies from where they go. So we'll provide investment advice to accredited and exempt institutional investors, family offices, sovereign wealth funds, and we will provide hedging strategies and metals management strategies to industrial users of metals, saying, okay, if we think that the price is going to rise, this is what you should be doing to protect your company and your company's cash flow and profitability from what we anticipate as either being a rising price in the case of fabricators or a falling price in the case of producers.
Great. Well, I'll put a link to CPM Group as well as your YouTube channel because you give out some really informative content there. So I think that's definitely worth people subscribing to. And thank you once again, Jeffrey, and look forward to having you on again at some point to continue the conversation.
Well, thanks for having me and giving me a platform, and call away. I'll be here.